Today, we're going to break down what futures are, why you need them, how people make money with them, and how entire fortunes are lost. This video will help you understand one of the most mysterious topics in finance: how you can make a deal for a product you've never even seen and still earn money from it, or lose everything. We'll talk about exchange contracts, real-life examples, speculation, risks, and all the little details you need to know to avoid falling into a debt trap. Stick around till the end to learn how not to lose money on futures and how to avoid becoming a victim of your own lack of knowledge. Give the channel a like and hit subscribe. A future is a contract, not for today, not for tomorrow, for a specific date in the future. You agree to buy or sell something, oil, gold, wheat, stocks, or even crypto, at a set price. But the deal doesn't happen now. It happens later, on a specific date. Sounds like science fiction, but that's how most of the global commodity market works. Let's say you need a power drill, not today, but next month. It costs $10,000 right now, and you're afraid the price might go up. You find a seller, agree on the price, pay a 30% deposit, and sign the contract. You're locked in to buy it for that price next month. If the price goes up to $11,000, you saved money. If it drops to $9,000, you overpaid. That's the core idea of a future. But sometimes the drill never arrives. In today's world, many futures are cash settled. That means you'll never get the physical product. On the contract date, the exchange compares the current price to the one you agreed on and adjusts the money. If the price went up, you profit. If it went down, you pay. That's how futures work. It's a deal from the future. You don't always get the product, but you always get a result. Futures weren't created for speculators. Originally, they were a tool for hedging, a way to protect against price swings. Join our Telegram channel. We post new video and article announcements there. Links are in the description or in the pinned comment. Picture a farmer who's growing corn. The harvest is 6 months away, but he wants to lock in the price now. So, he signs a futures contract to sell. This way, he knows how much he'll get paid. On the other side is a big company that makes cornflakes. They also want to know how much raw material will cost. Both parties get predictability. A future helps protect you from sudden price jumps or crashes. For the farmer, it's insurance against a bad harvest. For the buyer, it's a shield from shortages and price spikes. And that's the magic of futures. They make markets more stable by removing extremes. But if you're not a farmer and instead a trader, you can use this tool to profit from price movements. That's when things get riskier. Imagine you buy a future on oil at $100 per barrel, expecting it to rise, but the market crashes and oil drops to $60. Now your contract becomes a burden. You either pay the difference or close the position at a loss. If it's a cash-settled contract, the broker simply deducts the money from your account. This isn't some what-if scenario. This is standard. The exchange won't wait around for you to change your mind. If prices drop sharply, the broker will demand more funds. It's called a margin call. If you don't pay, your position gets closed and your deposit is gone. The money just vanishes. But that's also where the power of futures lies. You can control the risk. If you understand how margins and price movements work. If not, you could lose everything. You might never see oil, gold, or corn in real life. All you'll see are numbers in your trading account. Cash-settled futures are just agreements where you gain or lose money based on where the price goes. Let's say you bought a gold future for $1,500 an ounce. A month later, it's at $1,700. No one delivers gold bars to your door. You just get paid the profit, the difference between the two prices. But if the price drops to $1,400, you'll lose $100 per ounce. You can close the contract at any time before it expires. Just take the opposite trade. Sell first, buy later. They cancel each other out. That gives you flexibility to manage your position. No need to wait until the end. Even without physical delivery, futures can still be dangerous. A sharp price swing can wipe out way more than what you invested, especially if you're using leverage. Futures run on margin. You don't pay the full value of the contract, just a portion of it like a deposit. That shows you're serious, but it doesn't guarantee you won't go into the red. Imagine opening a contract worth $100,000 and only putting in $5,000. If the price moves against you, the broker calls, and fast. That's the margin call. You'll need to deposit more money to keep the trade open. If you don't, it gets closed automatically. That's how traders lose their deposits, especially when markets move fast and there's no time to react. On a chart, it might look like a small candle, but on your balance, it's a total wipeout. Futures let you control big sums, but one wrong move can be devastating. Doubling your account or wiping it out can happen in a single swing. You have to understand this. Futures aren't just about making money, they're about discipline. You need to monitor prices, react fast, maintain margin requirements, and know exactly what market you're trading. Speculating with futures can bring huge profits, but it can also drain your account in just a few hours. We've just published a new article on our website. There you'll find free guides on stocks, bonds, and ETFs, from beginner to advanced. Check it out and bookmark the page. For many, futures offer a way to trade assets without owning them. You don't need physical gold, oil, corn, or shares. You just make a deal and profit from price movements. Buy low, sell high, or sell first, then buy back cheaper. That's called short selling. Futures let you profit from both rising and falling markets. They give you flexibility and allow for all kinds of strategies, but only if you know what you're doing. Pro traders use them for speculation, investors for hedging. Newbies often treat it like a lottery, but this lottery doesn't offer refunds. And futures are leverage. They can lift your portfolio or crush it. There are two kinds of players: investors and speculators. Investors use futures as protection. A fund manager might lock in the purchase price of stocks or hedge commodity risks. It's part of their strategy. Speculators look for profit from price swings. They don't care about the asset or long-term plans. They want quick money, here and now, buy low, sell high, or the other way around. Their goal is to extract profit from every market move. But if you don't know how to use futures, they're dangerous. Without prep and risk understanding, they're like a landmine. You could win, but also lose everything and then some. Leverage, margin, collateral. They boost both profits and losses. Futures are not stocks. They need a special approach. The risks are different. First, there's leverage. You control big positions with a small balance, but losses grow too. Second, futures have a time limit. If you don't close the trade, the contract gets executed. You get the asset or you lose money. Third, huge price swings. Some assets, especially oil, crypto, or crops, can change by double digits in a day. That can wipe out your position in just hours. And then there are margin calls, the nightmare of all beginners. The market turns against you. Broker asks for cash. No money? Trade closed. And sometimes the move is so fast you can't even react in time. Futures aren't about stability. They're for those who know what they're doing, not for people who just want to try it out. At first glance, it's simple: buy low, sell high, or the reverse. But behind that is a complex world where context matters just as much as numbers. To trade futures, you need to understand market behavior, margin, position sizing, risk control, chart reading, news, reports on inventories, harvests, inflation, even the weather. This isn't intuition trading. It's about precision and planning. Many beginners jump into futures with excitement. They see the chance to make fast money, but they miss the risk. They go all in, set no stop loss, don't calculate margin, and lose it all. Brokers give access to futures, not insurance. The mindset of, "I'll figure it out later," doesn't work here. In the world of futures, later means your balance is already negative. Futures are a powerful tool. They let you lock in prices, manage risk, and profit from any market direction. They're used in agriculture, raw materials, investment funds, and speculation. But with the potential for gain comes high risk. You need knowledge, experience, and discipline. Guesswork doesn't belong here. One wrong move, and your money's gone. Give us a like and subscribe to the channel. Support our content through the membership platform, links in the description or the pinned comment.